The purpose of this presentation is to provide an overview of the policy events that have transpired in the residential housing market for the quarter, to provide an overview of the key trends in the residential housing market, and to provide an overview of the home price level for a select group of cities throughout the U.S. Before I begin, I would like to let you know that this presentation was produced by Troy Adkins. I am the founder and owner of Adkins Capital Management. Adkins Capital Management is a privately owned and independently operated company. Our exclusive focus is on residential real estate. Our company is not affiliated with any parties associated with the residential housing industry. As a result, the information and tools that we provide are objective and useful and offered exclusively to help prospective homebuyers make a prudent home purchase decision. In terms of my background, skills, and experience, I have more than 15 years of real estate analysis experience. I have more than 10 years of institutional investment consulting experience, and I have more than 7 years of freelance financial writing experience. Moreover, I am the author of more than 20 published articles, including publications by Forbes, Investors Business Daily, Yahoo, Investopedia, Financial Edge, as well as more than 230 news organizations worldwide. I have developed an internet-based residential real estate analysis software application that is marketed in the industry as the Adkins Residential Home Valuation Analyzer. Our software application utilizes proprietary finance-based and expense-based analytical methodology, which in turn allows prospective home buyers to determine the level of underpricing or overpricing of homes in their community, as well as accurately assess the costs associated with owning a home. Our goal is to offer a comprehensive, accurate, automated, user-friendly, and affordable residential real estate analysis software application in conjunction with contemporary information about the trends and events that are taking place in the residential housing market in an economical, efficient, and effective manner. Our commitment is to make Adkins Capital Management, the ARAVA Residential Real Estate Analysis software application, and our residential real estate research the premier analytical source for prospective homebuyers to use in order to make a prudent home purchase decision. Now that I have provided an overview of my company and my background, skills, and experience, let me turn your attention to the primary events that have transpired in the residential housing environment during the fourth quarter of this year. New lending guidelines from Fannie Mae and Freddie Mac, which are aimed at loosening constricted lending standards in order to make mortgages more affordable and easier to get for those with less than stellar credit, were the primary topics of discussion. The new guidelines clarify when mortgage lenders would be penalized for making mistakes on mortgages they sell to Fannie Mae and Freddie Mac. Following the collapse of the housing market that began in late 2006, mortgage lenders have been forced to pay tens of billions of dollars to settle assertions that the bad loans they wrote violated representations and warranties that were made when they sold the loans to Fannie Mae or Freddie Mac. In response to the forced repayment provisions, mortgage lenders have drawn their purse strings tighter than Fannie Mae and Freddie Mac require when evaluating loan applications, stating that the threat of repurchase demands makes the risk of mortgage lending worth taking only for borrowers with excellent credit profiles. Mortgage lenders blame the lack of clarity in the old lending guidelines as the cause for tight credit conditions. This in turn has made it difficult for many prospective homebuyers to qualify for a mortgage loan. Relaxing the mortgage lending standards could potentially make it possible for hundreds of thousands of additional consumers to obtain a mortgage loan. However, the new guidelines also increase the likelihood of default, foreclosure, and a repeat of the recent housing debacle. Fannie Mae and Freddie Mac also established new lending guidelines that will reduce the minimum required down payment amount to 3% from 5%, which was generally needed to qualify for selling mortgage loans to Fannie Mae or Freddie Mac. The reduction in the minimum down payment amount for most Fannie Mae and Freddie Mac loans brings the lending requirements in sync with the lending policy standards for the Federal Housing Administration. FHA has the mission of ensuring loans made to first-time borrowers and lower-income borrowers. Fannie Mae and Freddie Mac generally require borrowers who make a down payment of less than 20% to purchase private mortgage insurance in order to offset the greater risk to lenders that is associated with minimally collateralized loans. Under the new Fannie Mae and Freddie Mac guidelines, borrowers will still need to carry PMI insurance. According to the policymakers and the administrators of the government-sponsored enterprises, the purpose for changing the GSE's mortgage lending policy is to help increase economic activity by allowing more people to qualify for a mortgage loan. The implications of changing the GSE's mortgage lending policy is problematic from at least two perspectives. First, limited collateral requirements will increase the risk of default, which in turn will increase the potential financial burden on the lending institutions, the GSEs, and the taxpayers. Second, while mortgage loans that only require a minimal down payment amount appear to be a good deal for prospective homebuyers, from a financial perspective, homebuyers should not utilize such loans because the interest expense on these loans will make owning a home a very expensive liability over time. In terms of the policy events that took place during the fourth quarter of this year, general elections in the U.S. were held on Tuesday, November 4th, 2014. All 435 seats in the U.S. House of Representatives and 36 of the 100 seats in the U.S. Senate were contested. The election saw sweeping gains by the Republican Party in both the U.S. Senate and the U.S. House of Representatives. The Republicans will gain control of the U.S. Senate in January of 2015 for the first time since January of 2007. The Republicans will also increase their majority representation in the U.S. House of Representatives. Overall, the elections resulted in the largest Republican majority in the entire country in nearly a century, with 54 seats in the U.S. Senate and 246 seats in the U.S. House of Representatives held by Republicans. Given the upcoming Republican-controlled Congress, an overhaul of the U.S. housing finance system is expected to take place over the next 2 years. For example, Senator Richard Shelby is poised to take over the Senate Banking Committee and has expressed a willingness to move legislation that would have a significant impact on Fannie Mae and Freddie Mac. Senator Shelby was quoted as saying that he does not want any explicit guarantee for Fannie Mae or Freddie Mac. However, he also stated that this position would need bipartisan support in order to win President Obama's approval. Senator Shelby has signaled that he is unlikely to rely on the groundwork laid out in two bills, one by Senators Mark Warner and Bob Corker, and another by Senate Banking Committee Chairman Tim Johnson and Senator Mike Crapo, the panel's top Republican. The Johnson-Crapo measure was approved by the banking panel in May, but failed to gain any additional support. Senator Sherrod Brown, who is poised to become the panel's ranking member, said recently that he would push for a fresh effort and would avoid using the Johnson-Crapo bill as the foundation for new legislation. While Senator Shelby wants to end the government guarantee for Fannie Mae and Freddie Mac, Senator Brown wants to win provisions to help poor families get the necessary credit that will allow them to purchase a home. Removing the government guarantee for the GSEs and the concept of too big to fail is only realistic if the capital at the GSE's disposal is solely provided by investors. Unfortunately, it is highly unlikely that private capital investors will loan money for a long time horizon without raising the cost of debt for a mortgage loan. Going forward, the primary issue that may unfold in 2015 is not whether a reform deal for the GSEs can be reached, but whether those who still want to slay the GSEs while leaving nothing in return will have the leadership to make it happen. Moving away from the housing events to the housing trends for the fourth quarter of this year, it is important to note that the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan began the quarter at 4.11% and ended the quarter at 3.99%. Since June of 2011, the national average mortgage loan interest rate for a 30-year fixed-rate mortgage loan has been less than 4.61%. Most financial pundits expected the national average mortgage loan interest rate for a 30-year fixed-rate mortgage loan to remain steady or increase slightly by the end of this quarter. Most financial pundits are now perplexed about whether or not mortgage loan interest rates will increase, remain relatively flat, or trend lower in the future. The uncertainty surrounding the interest rate environment is very alarming because the Federal Reserve has set forth a plan to phase out its quantitative easing program. This in turn should promote higher interest rates in the future. Nevertheless, the future trend and level of mortgage loan interest rates will likely be dependent upon the operating status of the government-sponsored enterprises and their future role in the housing market. It is recommended that prospective home buyers pay close attention to the level of mortgage loan interest rates in their community, and keep in mind that a mortgage loan interest rate of approximately 5.3% will require them to repay to the lender twice the amount of their mortgage loan, assuming that they make their scheduled repayments and carry their loan to maturity. This relatively low interest rate and relatively high repayment amount illustrates the high cost of interest expense over time and illustrates why an end to the Federal Reserve's quantitative easing program may have a very negative impact on the price level and value of residential housing in the future. In order for prospective homebuyers to accurately assess the impact of a changing interest rate environment in their community, they can do so by using the Adkins Residential Home Valuation Analyzer. Now that I have provided an overview of the events and trends that have taken place in the residential housing environment for the quarter, let me now turn your attention to the methodology that is used to provide an assessment of the price level of homes in a community. In order to accurately assess the price level of homes in a city, the ARAVA Residential Real Estate Analysis software application analyzes the relationship between the median home price level for the city and the median household income level for the city. With this information, the ARAVA software application takes into account the most recent month-ending national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan, and the assumption that no more than 28% of pre-tax household income should be spent by homeowners in order to repay the principal and interest costs for their mortgage loan. By utilizing this information, the ARAVA software application can accurately assess the price level of homes in a city. From the first analytical perspective, the ARAVA software application determines the level of underpricing or overpricing of homes in a city by calculating the mortgage loan interest rate that justifies the price level of homes in the city. With this information, the justified mortgage loan interest rate is compared against the national average mortgage loan interest rate in order to accurately assess the level of underpricing or overpricing of homes in a city. To illustrate how this first methodology is utilized, let us assume that the ARAVA software application determines that the mortgage loan interest rate that justifies the home price level in a city is 6.5%. Let us also assume that the national average mortgage loan interest rate is 4.5%. With this information, homes in the city would be classified as underpriced because mortgage loan interest rates could increase by more than 2 percentage points before homes would be classified as overpriced in the city. Given this information, prospective homebuyers should reach the conclusion that it is appropriate to purchase a home in the city. From the second analytical perspective, the ARVA software application calculates the percentage of household income that would have to be spent by the people that live in a city in order to justify the price level of homes in the city. With this information, the ARVA software application compares the justified percentage of household income amount against the traditionally accepted household income amount of 28% in order to accurately assess the level of underpricing or overpricing of homes in the city. To illustrate how the second methodology is utilized, let us assume that the ARVA software application determines that the percentage of household income that would have to be spent by the people that live in a city in order to justify the price level of homes in the city is 48%. With this information, homes in the city would be classified as overpriced because the percentage of pre-tax household income amount would have to decrease by more than 20 percentage points before the price level of residential real estate property would be classified as underpriced in the city. Given this information, prospective homebuyers should reach the conclusion that it is not appropriate to purchase a home in the city. It is important to note that the ARVA software application allows prospective homebuyers to tailor their analysis to take into account specific household income amounts, home price amounts, cost of debt amounts, and percentage of pre-tax household income amounts. By tailoring their analysis to take into account these specific variables, prospective homebuyers can accurately assess the level of underpricing or overpricing of homes in their community. In terms of conducting residential real estate analysis by undertaking a historical assessment of U.S. housing trends, an interesting finding can be made by using the Adkins Residential Real Estate Analysis software application. For example, according to the U.S. Census Bureau, median household income was $52,250 in 2013 and $30,056 in 1989. In comparison, the median new home price level was $265,092 in 2013 and $120,383 in 1989. As you can see from the chart, it appears that a significant problem in the residential housing market has developed over the past 25 years, as new home prices have increased at a much higher rate than household income. Indeed, this issue could be a significant problem because most prospective home buyers obtain a mortgage loan in order to purchase a home, and they repay their mortgage loan with their household income. Therefore, household income and home prices typically need to move in lockstep in order to maintain a stable housing environment. With that said, the dramatic decrease in the national average mortgage loan interest rate for a 30-year fixed-rate mortgage loan in 2013, which was 3.98%, versus the national average mortgage loan interest rate in 1989, which was 10.32%, brings to light some key points that prospective homebuyers need to consider. For example, when people look at the relationship between median household income and median home price levels for 2013 versus 1989, there would likely be more concern about the residential housing environment in 2013 due to the pronounced mismatch between the median household income level and the median home price level during that time. However, due to the much lower cost of debt in 2013, only 29% of household income would have to be spent by homeowners in order to justify the median new home price level in that year. Moreover, the national average mortgage loan interest rate for a 30-year fixed-rate mortgage loan would only have to trend down from 3.98% to 3.7% in order to justify the home price level. Therefore, While on the surface it appears that a mismatch between the median household income level and the median new home price level was a material problem, based on the justified percentage of household income amount and the justified mortgage loan interest rate amount, the median new home price level was only slightly overpriced for the nation in 2013. In comparison, in 1989, the median household income level and the median home price level appeared to be more properly aligned. This in turn would likely lead people to believe that the residential housing environment was stable in that year. However, given the high cost of debt for a 30-year fixed-rate mortgage loan in 1989, 44% of household income would have to be spent by homeowners in order to justify the median new home price level. Moreover, the national average mortgage loan interest rate would have to decrease substantially from 10.32% to 5.75% in order to justify the median new home price level. Therefore, while it appears that the relative alignment between the median household income level and the median new home price level in 1989 was satisfactory in terms of maintaining a stable housing environment, based on the justified percentage of household income amount and the justified mortgage loan interest rate amount, the median new home price level was significantly overpriced for the nation in 1989. Now that I have provided an overview of how the Adkins residential real estate analysis software application is utilized, let me provide an overview of the home price level for a select group of cities across the U.S. For the fourth quarter of this year, 20 cities that make up the Adkins 60 City Home Price Index were classified as overpriced for the quarter. The top 5 overpriced cities were Honolulu, San Francisco, New York City, Los Angeles, and Newark. In terms of a relative price level analysis, it is important to note that given the home price level for the top 5 overpriced cities, it is not possible to justify their home price level by reducing the national average mortgage loan interest rate from 3.99% to 0%. Therefore, in order to classify the homes in the top 5 overpriced cities as underpriced, it would have to be deemed prudent by prospective homebuyers to spend more than the respective justified percentage of household income amounts, or the respective median household income level would need to increase to the appropriate level that is within the range of $49,760 and $147,276. As a last observation, based on the median household income level, the quarter-ending national average mortgage loan interest rate, and the assumption that no more than 28% of pre-tax household income should be spent in order to repay the principal and interest costs of a mortgage loan, the justified home price level for the top 5 overpriced cities would need to fall to the appropriate level within the range of $155,083 and $341,602. In order for prospective homebuyers to accurately assess the level of overpricing or underpricing of homes in their community, they can do so by using the Adkins Residential Home Valuation Analyzer. On the other side of the spectrum, 40 cities that make up the Adkins 60 City Home Price Index were classified as underpriced for the fourth quarter of this year. Detroit, Buffalo, Pittsburgh, Des Moines, and Wichita were identified as the most underpriced cities in the index. In terms of a relative price level analysis, the national average mortgage loan interest rate would have to increase from 3.99% to more than the respective range of 9.75% and 13.8% before homes would be classified as overpriced. In order for prospective homebuyers to accurately assess the level of overpricing or underpricing of homes in their community, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer. Given the events that have transpired in the residential housing market this century, and taking into account the fact that buying a home will likely be the largest single financial transaction that prospective homebuyers will ever make, and the bulk of their net worth will likely be tied up in their home, prospective homebuyers should subscribe to use the ARAVA residential real estate analysis software application in order to accurately assess the level of underpricing or overpricing of homes in their community, the largest amount of money that they should spend in order to purchase a home, and the amount of money they would need to earn on an annual basis in order to be able to afford to purchase a specific home. In addition, prospective homebuyers should subscribe to use the ARAVA residential real estate analysis software application in order to be able to accurately assess total home ownership costs expressed as a percentage of household income, and to be able to determine how much a home would need to appreciate in value each year in order to offset the costs associated with owning a home. By analyzing residential real estate from these perspectives, prospective homebuyers should be able to make a prudent home purchase decision. For more information about the Adkins 60 City Home Price Index and to access the Adkins Residential Real Estate Analysis software application, please visit the Adkins Capital Management website at residentialrealestateanalysis.com. Thank you for taking the time to listen to this presentation.